Indian economy is the fastest growing economy in the world today. The growth is driven not only by the consumer sector but also by infrastructure and manufacturing sector. Interestingly, there are some sectors and companies that are catering to both the infrastructure as well as the consumer segment. One such sector is wire and cable industry. Wire and cable stocks can be bought to play the capex cycle and the retail or the consumer growth story. Today, we will discuss the second biggest listed cable and wire company in the country, which is KEI Industries. About KEI Industries. KEI Industries is one of India's leading wires and cables manufacturer, with product portfolio ranging from house wires to extra high voltage cables. It is among few players globally with manufacturing capabilities for EHV 400 kV cables. What makes KEI Industries hot? First, it is among the fastest growing wire and cable company with over 7% market share. Second, KEI is among few players manufacturing EHV, that is extra high voltage cable. Third, KEI has added new revenue stream of FMEG, that is fast moving electric goods. Fourth, it is increasing its presence in the retail segment by growing its distribution network. Fifth, the Government of India has announced expenditure in infrastructure sector and housing for all initiatives that will boost the cable and wire industry. Sixth, KEI has shown higher than industry growth with its 5-year sales CAGR at 17% coupled with margin improvement. Portfolio analysis of KEI Industries. KEI has wide product basket with low tension power cables contributing to around 38% of revenues, followed by housing wires at 26%, and that is followed by high tension cable wires at 17%. These wire and cables have wide industry applications across industries ranging from power, oil and gas, railways, automobiles, cement, steel, etc. In terms of customer concentration is pretty low for KEI Industries, with top 10 customers accounting for 22% of sales in FY22, which is down from 29% in FY18. On the revenue split side, 49% of clients are institutional, 41% is from retail, and 10% of revenues comes from its exports. EPC segment. KEI plans to descale the EPC business at around 5 to 6 billion annually. This is due to low margin profile, high competitive intensity, and long working capital cycle. The FMEG or the fast moving electrical goods segment. This is a new revenue stream for KEI. KEI plans to widen its product offerings with FMEG by leveraging its distribution network. FMEG has strong growth outlook due to huge penetration scope and market share gains from the unorganized or smaller players. Other players like Polycab and Phenolix cables are among the large wire and cable players that have diversified into FMEG segment. New channels for growth, that is retail and exports. KEI's retail focus will aid increased B2C mix. The retail segment comprises of household wires, which is around 60% of sales, and low tension and high tension cables, which is around 40% of the retail sales. The segment has grown at a CAGR of nearly 20% in the last 6 years. The contribution from the retail segment has increased from 26% in FY16 to 41% in FY22. KEI is increasing distribution reach. KEI's dealer strength has grown by around 2.5x in the last 5 years, and KEI is further looking to increase the dealer or the distribution network by at least 10% every year. Exports. The $190 billion global cable market is expected to touch $260 billion by 2028. KEI has been focusing on export opportunity in more than 50 countries now. Exports accounted for nearly 10% of its sale in FY22. KEI has a strong order book for exports of Rs 621 crores as of October 2022. Let's take a look at KEI's financials. KEI has shown better than industry growth with 5-year sales CAGR at 17% and PAT CAGR at 33%. Its operating margin is stable at around 10%, but its net profit margin has shown consistent improvement over the years at 7%. On the cash flow side, the company will see higher cash flow from operations, but to enhance its capacities for low tension, high tension, and extra high voltage cables, KEI will incur a capex of 6 to 7 billion rupees over the next 4 to 5 years. That is around 1.5 billion per annum, leading to lower free cash flows. With respect to borrowings, the balance sheet is in a comfortable position with low debt equity ratio of 0.2:1. On the return ratios front, over a longer period of time, KEI has seen improving return ratios with better utilization of assets, and its ROE stands at 18% at the end of FY22. On the valuation side, at current market price of 1617 rupees, the stock trades at a rich valuation of 32 times PE, which is about 3-year median PE of 24 times. On the shareholding side, interestingly, the FII holding has gone up from 22% to 27% in the last 1 year, whereas the mutual fund holding has gone down from 24% to 19% in the last 1 year. During the same period, the promoter holding has gone down by 1%. Swot analysis of KEI Industries. Among its strengths are: first, it is the second biggest wire and cable company in India with over 7% market share. Second, it is among few players manufacturing extra high voltage cable wires. Third, its strategically located manufacturing facilities and strong R&D capabilities. Fourth, its strong presence in the retail segment with well-entrenched distribution network. Finally, its strong financials with ROE of around 18%. Among its weaknesses are its margin being under pressure, which is shown in low net margins, and also the majority of revenue still come from the wire and cable business. Among the opportunities for the company are: first, capacity increase in existing product portfolio by brownfield and greenfield expansion. Second, fast-moving electrical goods. That's a new revenue stream for the company. Third, fast-growing exports and retail segment. Fourth, Government of India has announced expenditure of Rs 111 lakh crores in the infrastructure sector. Fifth, Government of India's Housing for All initiative to bring $1.3 trillion investment in the housing sector. Sixth, strong growth in India's power sector. Among the threats are: inflationary commodity environment. Second, high competitive intensity. Third, delay in infra spending by the government.